Hey everyone, me Kevin here. Oh boy, the Federal Reserve is now talking about the potential for there to be a lot of room to cut rates because things could go south very quickly. This in a piece out from Nick T on my birthday yesterday. By the way, if you haven't seen it yet, I did have the fortune spending my birthday lunch with Kathy Wood in Florida, which was really wild because then I had birthday dinner with Lauren, my wife, in California. So it was a little bit of a long day, but technically that means I had a 27-hour birthday. Let that one sink in. Anyway, so plummeting inflation. That is Nick T's headline. But what's buried beneath the headline? Well, what's buried beneath the headline is very interesting. We're going to start here. Let's keep this simple. Let's say that core inflation is 4%. And these numbers aren't supposed to be exact. This is just to give you an example here, okay? Let's say core inflation is 4%. Let's say the Fed wants R star or R naught. No, not like COVID days. It's the level of restriction that the Fed has. Let's say they want that level of restriction to be 1.5%. Well, then your total interest rate at the Fed would be 5.5%. Okay, great. That's understandable. But core PCE isn't 4%. It's lower than that. It's probably closer to 3%. Okay, so let's throw on 3% here. And they want us to be at 5.5%. Okay, fine. So then we say this is 2.5%. This is another way you could achieve this. But what happens when core PCE goes down and you don't change the headline rate? So in other words, what happens if we take this delicious line right here for core PCE and we drop it all the way down over here? So we don't actually have 3% core PCE. We have, let's say, 2% core PCE. Well then, to have the same level of restrictiveness, we should actually be cutting rates a full 1% to about 4.5%. And the reason we would do that is because if you don't cut rates while inflation is falling, you actually start adding more tightness to the economy. And when you say you want to keep rates higher for longer, you're not trying to keep things getting more restrictive for longer or increasingly restrictive every single month for longer, because you're adding more pressure to the economy and you're likely to break something. You're likely to cause an unemployment-style recession, large joblessness. Okay, now, we understand this at least to some extent. The big thing to remember here, the big takeaway is if you don't cut as inflation is falling, you add more pain. Okay, fine. Well, maybe more pain needs to be added, right? I mean, the inflation figures are all rigged anyway. They're all fugazi. And yeah, to some extent, many of them are fugazi. But the Fed bases their rates on that fugazi. Okay? So what did the Federal Reserve think that inflation was going to be at the end of 2023? All right? So we look here. End of 2023 projection. And we can see this projection was made September 20th. All right? So what did we have September 20th? Well, in September 20th, we had projections that PCE inflation would be 3.3% and that core PCE would sit at 3.7%. And in June, the projection before that, we were at 3.2 to 3.7 or 3.9. So let's just take a midpoint here for a moment. So take a midpoint of these projections. Let's say basically at the end of the year, the Federal Reserve thought that inflation would be 3.25% on the headline and 3.8% on core. All we did here was take the difference between the Fed's June opinion and their September opinion, keeping in mind that their last rate hike was in July, in that midpoint. See that? What was their estimate of inflation here? What was their inflation estimate here for the end of the year? Well, that was between 3.25 and 2.8%. What did we actually get with the rigged numbers? Well, core PCE, instead of being 3.8% for core PCE, we actually got 2.9%. 2.9. And the annualized rate for the year, 2.4%. Well, okay, but what about headline? Headline, which was expected to be 3.25. Well, for headline, we got 2.6. So in other words, substantially lower. Now that's very interesting. So 2.6 for non-core is about 0.625% lower. That's like 2.5 rate cuts of 25 BPs lower than what the Fed thought it was going to be. And the core figure was about 30 basis points lower than what the Fed thought it was going to be. But not only that, this is where it gets a little ridiculous. Nick T makes this really interesting analogy. Well, I guess I shouldn't say it's really an analogy. It's kind of just pointing out by logic here that it might actually be even worse than what I've just described. The reason is, he says in the last 6 months, if you annualize what PCE inflation has been over the last 6 months, you actually end up finding that inflation has been 1.9%. Okay, so that's interesting. So the Federal Reserve is potentially way behind. In other words, they've already gotten inflation substantially down, at least via PCE and the Fugazi numbers. This doesn't mean prices are lower. Remember, the Federal Reserve isn't actually trying to get inflation lower. They're not actually trying to get prices lower. Like the inflation, all the crap we felt from 2019, they don't really care about you. They don't really care about you having normalized prices again and going back to 2019 prices. They don't care. How do you know that? Because they bluntly told us that. In the December FOMC meeting, Jerome Powell bluntly responded to a reporter who asked, hey, what do you say to the people who are upset everything is so much more expensive? And his response was, well, we hope they can make more money. In other words, good luck. Prices ain't coming down anytime soon. So where does this idea of a lot of room to cut come from? And where does this idea come from about potentially a very rapid decline, things going south very rapidly? Well, it actually comes right from the Fed as well. Quick note, this video is brought to you by StreamYard. Check it out, metkevin.com/StreamYard. They help me multi-stream broadcast every time I go live, which I do every day the market is open for the Market Open live stream. Take a look at this. First of all, there's the evidence of the 1.9% that I talked about the annualized rate of PC inflation between July and December, down from 4% in the prior 6-month period. But listen to this. Esther George, who left the Fed at the end of last year, so potentially could be a little bit more transparent, says, we made a very aggressive tightening. Not only look at the supply that came back, but also the demand that came back, down last year. But more importantly, listen to this. There's potentially a lot of room to cut rates before they are in neutral territory again. And you've still got quantitative tightening restricting the economy, in her words, on steroids. And on top of this, listen to this. Policymakers are right to be worried that cutting would blemish their credibility. However, in November, the hiring rate in the United States dropped to its lowest level in 10 years, a sign that more companies might feel they are overstaffed. The labor market is a tricky one. Before a downturn, it always looks like it's not too bad, and then it goes south quickly. In other words, the Fed's got to be very careful here. If they really start inducing an unemployment recession, we're screwed. Now, what's my opinion out of all of this? And what's Cathie Wood's opinion? Because we talked about this at lunch yesterday. Well, her opinion is the Fed has already gone way too far, and they're not going to be able to prevent deflation by cutting rates. I also believe the Fed has gone too far, but I believe the Fed, at least maybe I'm hopeful, will realize that and will cut rates. And while there will be a surge in unemployment, I'm hopeful that they're able to minimize the real damage of increasing layoffs, which have already begun. So in other words, I have slightly more hope than Cathie. In other words, she believes we are almost certainly heading into deflation. I think they'll be able to print their way out of deflation and kind of keep the Ponzi going a little longer. We'll see. Nobody knows. But the point is, the Federal Reserve, through their Nikki leaks, Wall Street Journal, buddy, is starting to signal that we may need to come down, frankly, just because inflation is coming in way lower than expected. Maybe it'll heat up again, but the data doesn't seem like it's indicating that it is. And if we look at the earnings calls we do every day in the course member live streams, what do we find? A lack of companies indicating they are remotely willing to raise prices, or even if they're willing, are unable to. Talked to Kathy about that yesterday as well, and she was shocked at what Texas Instruments and 3M told us about the lack of growth, the negative growth, the frankly negative growth they are forecasting. So, with all that said, and those manufacturing indicators, economic indicators, causing potentially more cause for concern, what's Jerome Powell going to tell us this week when the FOMC meeting takes place, which of course I'll be streaming in a couple days on Wednesday? Well, probably exactly what we just talked about. Now, we won't get a rate cut this Wednesday, but we are expecting to see the balance of the Fed saying we might have to cut just to stay at the same level of restrictiveness. We might see them try to explain that to markets, which potentially to stocks could be bullish. If they don't, the lack of them suggesting this could be bearish. We'll see what happens. Thanks for watching. Check out StreamYard, a link down below, paid sponsor on the channel, and we'll see you in the next one. Goodbye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker.